connected, but this is Scott with Athene. Want to thank Art Jetter and company for allowing us a little bit of time to go over Annuity Basics. So hopefully this will work out a little bit better this time through. My name is Scott McClure. I'm your business development wholesaler here at Athene. Be happy to go over annuities here today. Let's start out first. Why annuities? Well, in 2016, over $220 billion were sold in the U.S. annuity industry. 117 billion were fixed or fixed indexed annuities. The key reasons that folks purchase a fixed or fixed indexed annuity are safety and protection, and then of course income. Typically how annuities are sold is from the carrier to an independent marketing organization, a broker dealer, or a bank, then to an agent or advisor on over to the customer. An annuity is a contract between an individual with an insurance company. In exchange for the premiums paid, the monies may accumulate in the contract on a tax-deferred basis, may be paid out all at once or in a stream of payments over time. Common uses for an annuity is to save for retirement, create a dependable retirement income stream, and roll over from an IRA or 401k or other retirement plan. We do have two types of annuities, deferred and immediate. A deferred annuity generally accumulates tax deferred for more than 1 year before payments begin, often much longer than 1 year. Payments can come via withdrawal or annuitization. Immediate annuity is a SPIA. Payments begin usually within 12 months of the policy's issue. Annuitization, that converts an annuity balance into a stream of income payments, and payments can continue for a fixed period of time, or they can be guaranteed for life. Additional considerations when purchasing an annuity, we have single premium annuities versus flexible premium annuities. Single premium annuities are purchased with a single lump sum payment. Some actually can be modified for a short period of time. Some will accept additional premiums, usually during the beginning of the contract, maybe for the first contract year. Some will allow combining of funds from different sources not available on the same day. And then we have flexible premium products where payments are accepted for longer periods of time. For example, we have a multi-year guarantee product where you can add to that product all the way through the surrender charge period. So some annuities are going to be just single premium. Some are going to be flexible premium where you can add to them after issue. Also, there are issue age guidelines on most of these annuities. Contracts most often define a minimum and maximum issue ages. Usually the maximum issue age is somewhere between 80 and 90. For us at Athene, our highest issue age would be 85. So let's talk a little bit about tax basics with annuities. During the accumulation phase, interest earnings accumulate on a tax-deferred basis. No taxes are due until the funds are withdrawn. There's no 1099. There is compound interest, so you earn interest on the dollars that would have been paid in taxes when you keep it inside an annuity and you have tax deferral. During the payout phase, if payments are withdrawn, earnings are taxable as ordinary income. Earnings are, when they're first withdrawn, taxable as ordinary income in the year they are withdrawn. Withdrawals before the age of 59 and a half may incur a 10% early withdrawal tax penalty. If payments are annuitized, a portion of each payment is considered a return of premium. Now, we're going to look at non-qualified versus qualified annuities. On a non-qualified annuity, after tax, personal investment, that's going to be money that folks most likely have in their bank account. Premiums are returned tax-free, but any earnings on those premiums are taxed as ordinary income in the year that the client makes a withdrawal from the account. On qualified accounts, those are going to be your IRAs, 401ks, 457s, retirement plans, usually funded with pre-tax dollars. All payments are taxed as ordinary income. The annuity does not provide any additional tax benefit on a qualified account. So most annuities assess a surrender charge if withdrawals are made during an initial surrender period. The charge is typically a percentage of the amount withdrawn. Surrender periods vary by contract and product. Common surrender periods range from 5 to about 15 years. Liquidity during the surrender charge period. Most contracts allow for some liquidity during the surrender charge period, before the surrender charge applies. Usually a free withdrawal of about 5 or 10%. That's pretty common on most annuities in the um, in the in the industry. Remember, all withdrawals are subject to taxes on earnings, and withdrawals taken before 59.5 may be subject to an additional 10% excise tax. That's actually an IRS penalty because these are long-term retirement products. If you take money out of a deferred annuity before 59.5, you would be subject to that 10% IRS penalty. Additional liquidity provisions on annuities. Many contracts are going to have waivers, which include special benefits to aid with financial needs that arise under various circumstances. Waivers may follow for penalty-free withdrawals, may allow for penalty-free withdrawals up to specified limits if certain conditions are met. Common waivers are nursing home and confinement waivers, terminal illness waivers, home health care waivers. Waiver availability and terms may vary by company, by contract, by state where the contract is issued, or by other criteria. Also, RMDs, required minimum distributions. The tax code requires most qualified plans to begin taking income payments by the age of 70.5. Now, that was actually before the Secure Act, which was just passed last December. Now, clients do not need to start taking RMDs until age 72, unless they were born pre-July 1st, 1949. So many issuers allow such RMDs to be taken without penalty. Also, there are income riders that are available on annuities. Many contracts offer income riders. They're optional benefits usually available for an additional cost that guarantee a specified minimum level of income, often for life. So that is another reason why many people do purchase lifetime income annuities, to be guaranteed that they have an income stream for life. And even if they run out of money, the insurance company will keep paying that income as long as they live. So guaranteed income that can't be outlived. Very, very good reason to look at annuities for lifetime income payments. We do also have bonus provisions. May apply under certain conditions. Common bonuses are premium bonuses. Additional value can be credited to the contract at issue, goes right into the contract value, may be recaptured if withdrawals are made before a specified period. There are sometimes vesting schedules on the premium bonus amounts. Persistency bonuses are available in some contracts where additional values credited to a contract if it stays in force beyond a specified time frame. Also, there are income bonuses. Additional values applied if a certain withdrawal or annuitization payment option is elected. So those will vary again by company and contract. Availability varies by contract and state as well. Then we want to talk about guaranteed minimum withdrawal benefit riders. These are your income riders. Popular feature on many fixed and variable contracts, usually offered for an additional cost. Guarantees a specified level of income, usually for life, applicable even if the contract value reaches zero. Again, that's where the contract will still keep paying even if your value goes to zero. Then the insurance company pays it out of their pocket. Payable as a withdrawal, not an annuitization, so the annuitant still maintains control over the remaining contract value. Contract defines a maximum amount available for withdrawal, often based on the annuitant's age at the time the guaranteed payments begin. Payout rates increase generally if taken at an older age. So generally speaking, the longer you wait to turn on that income, the higher the payment would be. The length of time the contract was held before the guaranteed annuity payments begin. Income factors typically roll up for a specified rate each year. At Athene, we've got income products that'll roll up for up to 20 years before you can turn on that income to give your clients better income payments. Excess withdrawals may decrease the value available for subsequent guaranteed payments. That is the way it works. If you take out excess withdrawals while you're taking your guaranteed income payments, that will lower the future income payments going forward. Death benefit. There is a death benefit if the annuitant dies before the contract matures. Generally, with an annuity, they generally will bypass probate if you have a properly named beneficiary, so the payout will go directly to the beneficiary. It does not have to go through probate. Paid directly to the beneficiary or beneficiaries in either a lump sum, periodic payments. Sometimes will pay out over a 5-year period depending on the contract, or lifetime payments as well, depending on what the beneficiaries would like for their settlement option. So now let's talk about a little bit about the difference between the different types of annuities we have. There are fixed indexed and variable annuities. On a fixed indexed annuity, the owner earns a regular interest rate. So it simply may be a 2.5% interest rate guaranteed for 5 years. The company declares that interest rate at issue, and the company may offer multiple terms, usually 1 year or longer. For us, we have 3, 5, and 7-year multi-year guaranteed fixed products. Then also fixed index products. The owner earns regular interest, and interest is based on a portion of the return of one or more indices. So with an index product, we're going to actually look at the change in an index, and we're going to see the percentage of change over an amount of time, and that's how the client would earn their interest. The company defines how the index earnings will be shared. Company guarantees that the interest credit will never be less than 0. So one of the real benefits with a fixed indexed annuity is it has 100% downside protection. Your clients will never go backwards from any index movement. So again, just a nice way to cap any losses and still have good upside potential in fixed indexed annuities. A variable annuity, the owner may earn interest depending on the return of their sub-accounts. So in a variable annuity, the client is actually going to be invested in the market. They're going to pick the sub-accounts that they want to use to enter, to give interest to the annuity. Sub-accounts are similar to mutual funds and may rise or fall in value. So there are no guarantees on a variable annuity. You can gain value, but you can also lose value in your accounts, and that's why it's called a variable annuity. Variable annuities are considered securities and require securities license to sell. So to sell a fixed or fixed indexed annuity, you just have to have your life license and any annuity training if the state requires it. To sell a variable annuity, you would need your securities license as well as your insurance license. So now let's talk a little bit about interest rates, fixed rate annuity basics. Initial rates, the company guarantees that the initial deposit will earn a specified rate for a specified period of time, typically 1 year or longer. Renewal rates, after the initial guaranteed period, the insurance carrier will declare new rates for subsequent periods. They can be higher or lower than the initial rate, and they may have different terms than the initial period. Some contracts may offer a multi-year initial guarantee period, but only 1 year renewals going forward. Also, minimum guaranteed value. The company declares a minimum guaranteed rate below which the crediting rate will never fall. That's established at the time of purchase and applies for the life of the contract. There could be on some annuities something we call the market value adjustment, and that's a charge that may be applied when money is withdrawn or transferred before the end of the guarantee period, defined by the company in the contract, typically related to changes in the interest rates over time. So in general, if the interest rates have risen since the guarantee was established, the MVA will result in a charge or a deduction to the contract value. In general, if interest rates have fallen since the guarantee was established, the MVA will result in a credit or in an increase to the contract value. So here's the spectrum of risk and potential gains with annuities. Low or moderate return products are actually going to be CDs, bonds, or fixed annuities, just multi-year guaranteed straight fixed annuities. A moderate return with no market risk is going to be a fixed indexed annuity. Really, really good for safety and potential growth. And then if you're looking for a higher return, you could certainly have a variable annuity. It's going to be much higher risk. An example of a product that would be similar would be stocks, mutual funds, or of course variable annuities. So fixed indexed annuity basics. As with fixed annuities, indexed annuities include term lengths, generally 1 year or more. We here at Athene have them from between 5 to 15-year lengths. Initial cap rates, they're assigned to the annuities contract at the time of purchase, applicable to the term selected. Renewal cap rates declared after each index term, applicable to the next term. Minimum guaranteed values declared at contract issue and applicable for the life of the contract. may be set by a formula. So, thing that you want to remember about a fixed indexed annuity is it's not invested in the market. It's not even invested in the index. We are simply tracking an index to determine how much interest the client earns in their annuity. So, fixed indexed annuity provisions. Interest rates are linked to a portion of the upside performance of an outside market index. We have a number of different indexes here. Probably the best well-known index is the S&P 500, used by a lot of companies. We also use it here at Athene. Potential for greater interest crediting compared to traditional fixed annuities. They do have a better upside potential than just a straight fixed annuity. And the indices vary by company. So we talked a little bit about the S&P 500, the Dow Jones Industrial Average, the NASDAQ 100. We actually just came out with a new NASDAQ 100 index ourselves. Hang Seng, the Euro Stock 50. There are a number of different indices out there that different companies use to measure what interest rate the client can earn. So index interest crediting, index may move up or down. The accumulated value increases as the indexed interest is credited based on the upward movement of the index. It's linked to, but not equal to, the market index return. So generally speaking, you're going to have a participation rate, a cap, or a spread, and you'll get a portion of that upside with a fixed indexed annuity. The accumulated value does not decrease if the index movement is negative or flat. So that's where we say zero is your hero in the annuity industry. With these fixed index annuities, if the market drops like it did yesterday, you will not lose any value in your fixed indexed annuity. They're all have 100% downside protection, and so you don't lose if the index goes down. You just get a zero credit for that year. So let's talk a little bit about how fixed index annuities are credited. There are a few different crediting methods. We've got caps, we've got spreads, participation rates. So a cap is the client would earn whatever that index does up to the stated cap rate. So an example is, if the cap was at 5% and that index earned 3%, the client would earn that full 3%. If the index did 5%, then the client would be credited 5%, as that is the cap on it. If that index returned 9%, then the client would still receive a 5% credit, because that is the cap, or the top rate that a client can earn with a cap. So the cap's going to put an upper limit on what the index can earn for that particular year. Also, there are spreads. A spread, I like to think of it as kind of a hurdle rate, the return of the underlying index less the spread rate. So an example, if we had a 2% spread and the index earned 3%, the interest credited to the account value would be 1%. The difference between 3 minus that 2% is 1. If the index earned 5% and there was a 2% spread, then we would credit 3% to the client. And then if the index earned 9% with that 2% spread, the client would be credited 7%. So like I said, it's kind of a hurdle rate. The spread goes to the insurance company, and anything that's left over would be credited to the client's account. Now, we also prefer participation rates. That's our third option here. The return of the underlying index is multiplied by the stated participation rate. So what that means is we don't put any upper limit like we do with a cap. For example, if we have a 50% participation rate and the index earned 3%, the client would be credited 1.5. If we were at a 50% participation rate and the index earned 5%, we would pay the client 2.5%, 50% of that 5%. And if the index earned 9%, we would credit the interest to the client's account of 4.5%. Again, 50% participation in what the index earned, so half of that 9% would be a 4.5% credit. So interest crediting strategies. Approach used to measure the amount of interest credited to the annuity as a result of change in an index. Common strategies, we've got a fixed rate, usually just a 1-year guarantee. Very often we use a point-to-point, and that's going to be an increase from a specified date to 1 year later. So if the client opened the account on June 6th, we'd look at that account on June 6th the next year and see how much change there was in the index, and that's how we would credit interest to that client's account. There's also monthly averaging, where we look at the percentage of change in the index compared at the beginning of the index value to the 12-month average using the average index value. So simply what we do with that one is we look at each month's change and we average it together. Monthly cap, same as the point-to-point strategy, but on a monthly basis. After 12 months, all 12 months percentages are added together. So let's talk about the summary of annuities. Annuities are very good for safety and protection, provides upside potential with no risk of loss in any of the fixed indexed or fixed annuities, are available for income. They all have tax deferral. Some have death benefit options, and a lot of them are going to have different liquidity features. Certainly a lot come with free withdrawals at 5 to 10% penalty-free available every year. Some have nursing home waivers, terminal illness waivers, or confinement waivers. So if the clients are confined to one of those facilities or terminally ill, they can get some or all of their money back surrender charge free. And so with that, I'm going to throw it back to Kathy. Kathy, are there any questions that we can go over here before we close up the presentation today?
Yes, we have one question. Wanted to know how often can the indices and those options be reallocated?
Generally, if it's a one-year strategy, you can generally reallocate every year. There's usually about a 30-day window right before or right after the contract anniversary when clients receive a renewal letter, and they can reallocate at that point. Again, there are some contracts where we also have two-year strategies. In a two-year strategy, you could reallocate every 2 years, but generally every year or every 2 years, just depending on the index options available in the contract.
Okay. Well, that was the only other question asked online here. So I want to thank everyone for sticking with the webinar this afternoon, even though we started with some technical difficulties. To begin the webinar, we ended here with some really solid information, and want to thank Scott McClure for taking the time to explain the basics of annuities to everyone. And also to thank the agents out there who joined us today. We encourage all of you to start thinking about annuities and clients that you might have in your book of business that could benefit from having that solution in their overall portfolio. So our team is standing by. If there are any further questions or you'd like an illustration or additional training, please give us a call. We're at 800-228-0008. My extension is 1015. And want to thank everyone again for attending us, and enjoy the rest of your day.